Hey everyone, it's Kirk here again at Option Alpha. Thank you so much for joining me. This is episode 5 that we're doing here today, and we're going to be talking about the performance of trade ideas. We've got some new stats and new data to share with you. And if you've been following along this entire series, you know that what we're trying to do in this show is really show you some of the new research and data that can help inform and drive some of the decisions you make in trading. My goal is to get you to start trading options trading 2.0 style, which is better than options trading 1.0. Options trading 1.0 is all the stuff we used to do as traders. We would guess randomly at strikes and expirations, just do whatever kind of felt like it was the right thing. And options trading 2.0, which I'm trying to get a lot more people to do, is trading based on math and data and probabilities, leaving your emotions at the door, checking those at the door, and just trading based on the systematic, mechanical nature of trading that we all can do a lot better. So I hope you guys are going to enjoy today's episode. Today, we're going to be focusing on, if I can just get the slides pulled up here, we're going to be focusing on trade ideas performance. So the last couple episodes, we've been talking about expected value, doing a lot of EV stuff. Then we were talking about alpha and how we can use alpha to compare trades, kind of apples to apples against risk. And then in the last episode, episode number 4, we looked at this moment in time probability research where people had wrongly assumed in many cases that if an option probability shows 70%, that probability is only valid for that moment in time. Like it doesn't really carry through most of the expiration, or that probabilities don't carry through the expiration cycle as still being valid. And we showed a lot of new research on that. So if you want to go back to any of those episodes, you can. Today, we're going to be focusing on even more data that we've collected on trade ideas and trade idea performance. Basically, we've totaled up about 1.7 million trade ideas into this. So there's a lot of data and a lot of research behind this through various expiration cycles, through the November cycle. So I hope you get a lot out of this. I definitely think there's going to be some pretty strong key pull away, like golden nuggets that you're going to take from this as to what is generally working and not working as we start to unpack this idea of trading based on math and probabilities even more and start to figure out, okay, if we want to trade based on expected value and alpha, what does that look like? We started talking about that last week. We're going to dig into it a lot more here. So the first thing that we want to go through inside of here is I wanted to mention that as we're doing this, a lot of the research that you're going to see today was from or up through November of this year. So we kind of wrapped it up in the beginning of December and published it, but the research is up through November of this year. And this is really good because right now, like at the time where the market is having these absolutely crazy, you could call it almost like throwout type period metrics where the market is going straight up. This is some of those times where people often will throw these metrics out and throw these numbers out of their research, but it actually is the best thing for us right now, because if we're going to evaluate probabilities, we should do it in some of the worst, air finger quote, worst market conditions where markets are not behaving normally or rationally, air finger quotes if I fit them in the screen there, but where markets are not behaving normally or rationally, and they're just like one-way directional move up. And so you actually saw this month with the S&P, actually the last month and a half, you've seen this with the S&P, where the S&P has just gone absolutely straight up with everything else. And that's good because although we didn't capture all of it since, December 1st to now, which is still going up, we captured most of this, like just absolutely relentless move up that the markets have been on. And so that's part of this research too, which makes it even more appealing to use some of this if the data proves out to work in our favor. Now, this is actually a really interesting chart. So what you're going to see here on this chart, and this is the average P&L for trade ideas, expected value over time. And essentially what you see with each of these little graphs or lines is basically like a 2-week rolling number of the P&L and the average expected value for trade ideas as we go through time. So let me just describe how it works this way. So August 1st, that was essentially the first time that we collected a pool of trades, and then we analyzed it and we said, okay, the expected value of the trade was this, and the real P&L of the trade was this. So if the expected value is A and the real P&L is A, they matched up, great. But if they deviated, that's when we would start to see it. So after August 1st, we collected that first, call it basket of trades, like the first set of data came in. And when we added the next sequential set of data, which was August 15th, it wasn't that we were looking at just August 1st to August 15th. No, we were looking at when we started tracking, which was like early June, July, we started tracking these. Now we added another 2 weeks worth of data. So you can think about the difference right here in the graph, right up here, August 1st to August 15th. These two lines are basically, we're starting to add data to the research models, right, where we're starting to add more and more data as we go through time. And so you can see that as we go through time here, and we see that August 1st and now August 15th, we've added more data. And now September 1st, another 2 weeks have gone by. And so September 1st line, which is that gray line right in there, that's now showing, okay, another 2 weeks of data has been added. And what you see in this chart, you can literally see the visual representation of the law of large numbers really start to play out here as you start to see this line start to, let me go this way because you guys are watching it this way, but you start to see this line, this expected, P&L line versus the actual P&L line start to converge on the theoretical perfect line, which is the one here, the dotted line here. That's the theoretical perfect line that's in there, okay? And so in this case, what we see visually on this chart, which is why it's so important, is we see that as we continue to add data to this and the sample size gets larger and larger, we start to now converge onto this line, which is good. Now, what you did see in this, and this is what's really crazy about just looking at the data this way, but also just taking a step back and kind of analyzing it with an objective view, is that you saw that once we added November 1st and November 15th, so basically the entire month of November, that basically put this thing out of bounds to a certain degree, just those 2 weeks. So if we just look at those 2 weeks and we don't add them into the actual like total that we've had here, if we just kind of strip out November 1st and November 15th periods, you can see that November was a really abnormal month for sure. So it was actually showing on this chart that expected values versus actual values were somewhat disconnected to a certain degree in November, which makes a ton of sense because if you traded through November and the market just went vertically straight up and you tried to do everything under the sun, like iron condors or call spreads or whatever, you basically did anything except long calls, you got your face ripped off on many trades. And so you can actually visually see this here on the chart. You can see that November 1st and November 15th, that subset of trades right there was actually a subset that showed that it was below the expected theoretical perfect line. Now, the important thing here to remember is that although it was below the perfect line, it was still profitable to do so, although you had some more volatility in your P&Ls, but it was still profitable to do so. The last thing that you want to look at here is the average. This is the bolded line. This is the average of all combined months. And you can see that that bolded line is getting tighter and tighter and tighter around the expected outcome, which means that, yes, November might have been a month where if you traded something and it was an expected value of 40, maybe the P&L ended up at 20. That's basically what these data points are showing, is that if you had a trade that had an expected value of 20, your actual realized value might have been 25, something like that. So there's a disconnect there. But if you average all of those out between November and October and August and June and July and all these months, September in there, you average all those out, 1.7 million trades, you get an average that's almost right along that perfect theoretical expected value line, which is good. This really tells us that this has some robustness that we can use it moving forward in our trading. Okay. So that's the first thing. I hope you guys really enjoy this one. If you do, let us know so we know we're on the right track here. Okay. Now we actually split this out even more. So this is where it starts to, I feel like actually the last one was interesting, but this is where I say this one actually really starts to get interesting. Now, before I keep going, by the way, if you have questions that you want to add in here, go ahead and add them into the chat. If you're joining us live, if you're joining us afterwards, just add them into the chat and YouTube later on. If you have a question that's kind of off topic, I'm not going to answer it here. I'll just answer it at the end and we'll kind of circle up on those. So I'm not avoiding those. I love you, love your questions. I'm not, ignoring you completely. I just want to make sure we stay on focus and on topic with what we're going through here. So, okay, so this is a really interesting one. So what we were looking at here is we're looking at the average P&L for trade ideas, again, by expected value. But this time we subdivided everything into days to expiration groups or buckets. And what you see here is you see the different buckets. So this very top bucket here that you can see, the very top line, at least I'm circling here with my mouse, those are trades that were entered at 31 to 35 days until expiration. So you could think about those trades as trades that were entered about a month out from expiration. This other bucket here that I'm highlighting, this farthest right one that's kind of in orange, these are trades that are about 21 days to 25 days out to expiration. So not quite a month exactly, but just under a month out from expiration. Now, what you see visually here, and we try to represent this as best we could through the use of just colors on here, but you can actually visibly see that there is a big disconnect. It's almost like the seas are parting at a certain time of days to expiration. You can see that it literally parts, right? Where one cluster goes one way and the other cluster of days to expiration goes the other way. The cluster that is more in line with the theoretical perfect EV line, which is what we want. We want trades that say I'm going to make $10 and make $10, or say I'm going to make $50 that actually make $50. We want more of those types of trades that we can rely on. And you can see that that cluster is actually trades that are above 20 days to expiration. That's a really important, highly key takeaway for your trading, is that what you see here is that trades that are entered more than 20 days to expiration, no matter where they are on the EV spectrum, whether they're $2 of expected value or $40 or $60 or $70 or whatever, trades that are entered on the EV spectrum, or that are entered over 20 days until expiration, are much more correlated with actual P&Ls that you realize after the trade closes. That is a ridiculous takeaway. I don't think I've ever seen anybody anywhere talk about this type of outcome or this type of like takeaway from research like we're doing right here. Kudos to our team, mainly Rob from our engineering team, who's also our mad scientist on the options trading side, for putting this together, because this is a massive takeaway for you that you can apply literally right now in your trading. You can see visually that all days to expirations that were under 20 days all had suboptimal performance compared to the expected outcome. So what this means is that if you're trading right here, which is like, say these are the 11 to 20 days right here where my cursor is, these trades right here had an expected value of $60 when the trade was going to be put on. That was the calculated expected value. But for whatever reason, trades inside 20 days actually never reached a full realized value of $60. The realized value of those trades in some cases was maybe $10 or $12. In other cases, some of the ones that are 0 DTE, 1 days to expiration, 6 days, 9 days, were negative expected outcome. Now, you could say that some of this may have been dragged down a little bit by November, for sure. And I think that that is part of it. But that's still a lot of data and a lot of trades that are completely disconnected from another very clear subset of trading, which is 20 days or more, 20 days or more from expiration entered. All of those trades, even including November, because this all includes November, which was wildly different, clearly shows that trades under 20 days have a lot more volatility. Basically, they just move too fast and a lot of stuff happens in that time period. Noticeably, and this is one of those key takeaways that I think you should walk away from this with, a lot of people like trading 0 DTE strategies. 0 DTE strategies effectively did not work if you traded with expected values greater than 10. So if your expected value was greater than 10 on a 0 DTE strategy, you pretty much had a good shot of not making money on that trade once they actually realize themselves. The only 0 DTE strategies that worked out were expected values under 10, which means that they were pretty close, pretty tight. So the pricing probably was pretty accurate for those trades to begin with. But you can see, again, visually here, and this is crazy that you can see this difference, but there's a massive difference between 20 days to expiration and above and 20 days to expiration and below. Now, we also did this for the average alpha as well. So remember the last couple episodes that we've been doing, we've been talking about how alpha is a great metric to kind of normalize things, which Alpha for us, the way that we calculate is we just take the expected value, we divide it by the max loss. That gets you a normalized kind of like expected value per unit of risk, essentially, that you're taking. So this was a little bit different. We didn't expect it to be exactly the same as EV because it's a different calculation factoring in risk. But we also saw that broadly speaking, and again, this is broadly speaking, you see the collection of trades that were significantly higher and towards that expected outcome that we were looking for, where if we're shooting for a trade that has a 5 alpha, we want to have a trade that hits about a 5 alpha, is you see all these trades that were plus 20 days to expiration, plus 20 days to expiration. Most of the ones that were sub 20 day to expiration trades here, you can see those trades here were not performing well. They were kind of deviating from the theoretical perfect expected value. So you see like the 6 to 10 days was terrible, like literally terrible to trade. 0 to 5 days to expiration actually ended up doing well on a risk-adjusted basis. And that was mainly if you were taking in really, really high premiums on a lot of these positions and trying to get a lot of premium per unit of risk that you were taking in. If you were taking in really small premiums with really high risk, probably didn't work out as well as the opposite, which is high premiums against high risk. So really high alpha or expected alpha. If you collected a lot of premium on those 0 days to expiration ones, you ended up doing a little bit better than if you didn't otherwise. Okay. So really good takeaways here. Still proves the point that we're trying to make, which is that 20 days and under has some issues potentially with trading. Now, just for good measure, what we did is we took a look at the average P&L for trade ideas for all trades and filtered out trades that had expirations under 20 days. So basically, this is looking at all trade ideas, cutting out everything under 20 days to expiration, just looking in one group, kind of an average or summarized table here of all trade ideas that were plus 20 days to expiration. So it could have been 20 days, 25, 30, 35, 40, 45 days to expiration, et cetera. And you can see how well this, basically the expected numbers track the actual P&L numbers of those trades. Now with, in many cases, thousands, tens of thousands, even hundreds of thousands of trades, you can see how reliable this is for 20 days and out on the expected value that you should look for in a trade and what you actually should get, okay? Someone had a good question here. When you say, for example, 0 DTEs of expected values of $10, what is the $10? Is it $10 or points? It is $10. So if we are looking at expected value here, $10 means $10 per contract. So if you do multiple contracts, that particular person would have multiple hundreds of dollars. But in this case, because we just normalize it per contract, then we put it in there as $10. So this right here is showing, for example, this data point here, which is 39,800 trades in this data point. So that data, the numbers here are the number of trades for each of these data points, just so you know. So 39,800 trades went into this particular dot on the graph. This is expected values between $30 and $40, ended up being actual P&Ls between $30 and $40. So the actual expected or the expected outcome and the actual outcome ended up being almost identical, almost mirroring one another. The one right here, which is about 111,000 trades in this data point, was almost perfectly right on the expected value line, which means that if a trade said it was going to make $15 of expected value, if you let that trade play out, it made $15 of expected value. That is banana type information that hopefully you guys can take away and improve your trading moving forward, because this is nowhere else. I've never seen anything else like this. Okay. The other thing that we did inside the research, and we'll just keep hammering this home because this is actually really, really powerful stuff. The other thing that we did is we said, okay, maybe there's a split in this because of probabilities, right? Which is a logical question. So maybe there are some differences in how different trades worked out because different trades had different probabilities. But we didn't find that actually. In fact, what we found is that trades that were entered at or beyond 20 days to expiration, regardless of whether they were an 80% or 90% probability of success trade, or a 70 and 80%, or 50 and 60, or a 60 and 70, right? You can see we tested all high probability trades bucketed by probability and greater than 20 days. No matter what the probability of success was, essentially, trades that were entered more than 20 days had a higher likelihood of being very, very well correlated to the perfect EV line. Now, if we bucketed trades that were under 20 days and we subdivided those trades under 20 days by buckets as well as, okay, well, what if it's a high probability, like really, really high probability trade, right? And it's under 20 days. Surely that works out. And here we found it actually doesn't. It doesn't matter that the probability was a 70% chance of success or an 80% chance of success or a 90% chance of success. Just the sheer fact that you were trading under 20 days to expiration meant that you saw a lot more volatility in your expected outcome versus your realized outcome. Now remember, and this is a key point here too, is that as you go out this expected volatility like timeline, I guess you could say, like you go out towards further and further and higher EV buckets, then the disparity in performance is going to be greater and greater and greater, right? I guess you could say it's like gravity and time distortion. Rob, if you're watching this, you'll be like, yes, that's exactly right. So the further and further you go out on this graph here, you go further out to higher expected values, the greater the difference and distortion you're going to see between your actual outcome. You're all the way out here thinking that you're entering trades 90% chance of success for a $90 expected value, and the trade actually plays out. You win maybe 90% of the time, but the actual P&L of the trade ends up being zero. And that's incredibly frustrating as a trader because you think you're doing everything right. And this probably explains why a lot of people enter short and just are impatient, enter short trades for short premium, high probability of success, but never make it anywhere. Like they don't see consistent results because they're just churning their account, not finding success, getting into trades that just have break-even average P&Ls. It's highly fascinating. Now, again, it's really insightful that those trades that were short duration trades that worked out, essentially the only ones that worked out were trades that were under, call it $20 of expected value. So if you want to trade short duration, maybe you trade short duration, very, very small profits. It still wasn't even better than trading slightly longer duration, right? And trading it for higher, a little bit more premium, and just flat out waiting and being more patient with your trades seems to have worked out pretty well. Okay. Here's another one here. I think this is our second to last one. Let me just check my slides here, make sure. Yeah, this is our second to last one here. Okay, so this was the average rate of return for trade ideas by alpha and probability range. Again, we did the same sort of split here where we're splitting it up for all trades that were entered beyond 20 days to expiration and all trades that were entered inside of 20 days to expiration. So that split is shown here as well. Again, all trades that were entered inside of 20 days to expiration, kind of this blue subset on the graph, if you're seeing it here visually, you can see that when we marked alpha, these trades did not have consistently positive alphas or consistently positive alphas that match the theoretical perfect rate of return on these trades, right? We started to deviate the further and further you went out. And again, it did not matter whether you were trading mid probability of success, so coin flip type trades, or you were trading high probability of success trades. It just really, frankly, didn't matter. Trades that were taken under 20 days were underperformers versus trades that were taken over 20 days. Now, again, here in the case of alpha, and this was a really interesting one as well, this kind of proves a very interesting point in a lot of this research, particularly with alpha, is that when you got to trades that were further out the alpha bucket level, you started to see the realized rate of return start to flatline. And you can actually just visually see this, how in this case, the darkest line here goes up. And then you get out to about a 10 alpha, like a 10% alpha. And once you hit that level, it almost flatlines. So there's really no point in trying to get those higher alpha trades, right? If you find a higher alpha trade, some people actually have filters in place to try and find trades that are 40% or 50% alpha. And while that's great and cool, and you can do that, it just really didn't actually pay off. You might have been taking potentially a little bit more risk because of what happened during the time period that it took to capture that alpha that then you should have been taking. And so you were better off in many cases taking an alpha that was overperforming what you expected. In that case, you would be in the, call it sub 20% alpha range, where you're taking in a trade that's not a grand slam killer, right? Like that's how I would describe it. You're not looking for the trade that's going to make $200 and risking $15, to be highly exaggerated, right? You're not looking for that trade. Instead, you're looking for the trade that is taking in $20 and risking $100, right? Like that's potentially a trade that you might want to take, or let's say it a better way, where the expected value is $20 and you're risking $100, right? Like that's a better trade because it's in that 20% bucket right there, which almost perfectly matched up to the expected outcome. That's the trade would have won on average $20 per $100 bet. That's a better trade. So there's definitely some legitimacy to the idea of not going for those ridiculous home run trades, no matter where they are in the days to expiration timeline, whether they're beyond 20 days or inside 20 days, doesn't matter if they're high probability, low probability, you start to see that your biggest essential bang for buck in alpha or risk adjusted returns or expected value per unit of risk that you're taking in was probably found somewhere in the 0 to 20% alpha range. And so with that in place, like that combination, in combination with just positive expected value generally, and then an alpha around 20% or so or less, right? What you found is you found probably a nice little, I wouldn't call it a sweet spot, but definitely a more tighter, controllable, rigorous, definitely improved area of trading if you went 20 days out, alpha around 20% or less, so call it like 10 to 20%, and positive expected value. Those probably ended up working out pretty well for you, regardless of the probability of profit that you had on your trades, which is at that point just pretty subjective. So it just depends on how you kind of want to manage your positions and trades. So I think this was really helpful. I think, again, just to kind of summarize here, what we observed, and then we'll jump into the platform for a couple of minutes and just kind of look at how you can set this up with your trading. But we observed a significant performance split, like I said, at 20 days mark. The longer DTE trades aligned a lot more closely with the expected value and the models that we had. And this was particularly evident in the 50 to 80% probability range. Now remember, those short-dated trades under 20 days to expiration not only were reduced predictability, but were also reduced profitability, which was really key. So that was a real big takeaway from this latest research, and again, can help inform some of your decisions. Now, all truth be said, like all of our models for Option Alpha for EV are based on a 30-day historical volatility. So there also might be some legitimacy to the fact that most of the analysis and calculations are using a 30-day model and then trying to abstract, shorter time periods from that. So we're internally looking at how we can potentially use different models or different ways of expressing that model on shorter time periods. But basically, it's like good data in, good data out. You should kind of match what the expected values are charting, which is around a 30-day, historical time period, which means that anything in that average 20 to 45 days or so should end up working out as they should, because that's what we're basing the historical volatility on to begin with, right? And so that's really key. So here's what we're going to do. We're going to jump into the platform here because I want to show you guys how you can build this out for yourselves inside of a brand new bot. So I'm going to start with a blank bot here. Let me just actually share my screen because I forgot to share my screen here on that. Was this really helpful, by the way? Hopefully it was. Okay. Can you guys see this now? All right, great. So what I want to do here is I want to build this out for you guys so you guys can see how you can do this inside of your own account on Option Alpha. So this is just a trading account. You just want to go up here to the top right-hand corner to build out a brand new bot. You can do this multiple different ways, by the way, but this is potentially one of the easiest ways to do it. Actually, you know what? I'm going to do a different way. I'm going to go to Trade Ideas, which is where you can start to find trade ideas like this. We've used this in a number of different episodes where we are looking at alphas and expected values. And this is really cool because you can, again, start to make these sorts of adjustments here inside of Trade Ideas. And then you can just hit the button here to auto trade, and that builds the bot essentially for you on the fly. So here's what we're going to do. We're going to trade only ETFs. We're looking at credit-only trades, right? So we still want to be short premium sellers, et cetera. And now we're going to make that adjustment to our days to expiration. We're going to say that we want to do, let's say, 21 days to the max here, which is 45 days. And then we're going to go here to alpha. We're going to do alpha that's, let's say, 2% or more. And expected value, let's just say it's, let's say, $5 or more. And we can even subdivide this even more and say that we want to take trades that are 60% chance of success or more. And so right there, just with a couple of these metrics, we're kind of almost exactly mirroring what we said and what we see in the research as working out better than some of the other things, which is we're not going to trade short days to expiration. We're not going to trade low probability. We're not going to trade negative expected value, of course, that's a staple. And we're not going to shoot for really, really high alpha ratings. So if we did shoot for a high alpha, I don't even know if any show up. Yeah. Anything that's really, really high alpha, 20% or more, let's say 25% or more, we know that these trades will work, but it's just that they won't work out exactly like the alpha is expected here because they just don't when you take in more risk on some of these trades. So we want to take a trade that's a little bit more modest here. So again, we could even do 5% or more if you wanted to. And then now we have a pretty good list of trade ideas to select from. Now you can just make any of these trades right here today. You can just go in here. You can find a trade you want to make and place the trade in your Tradier account if you want to, and let the bots automatically manage the positions. What we can do here though is now with this setup in place, we can actually go up here to this button, which is to auto trade. And basically what we're going to do is we're going to use the bot wizard here to create a bot for us automatically based off of this criteria. So we put in this criteria, we have to choose our tickers that we want to trade, for example, and then the bot gets created automatically for us. Now we can modify this bot, we can adjust this bot, you can add to it if you want to, but it's a good way to get started right off the bat with important data and probability metrics from research, and then applying them to an actual automated trading strategy. So first thing we have to do is we have to choose tickers. We got to know exactly what we want to choose and trade. So let's go in here. We'll do IWM. We'll do Qs, SPY, TLT. We can do USO, XBI. It doesn't really matter. We just choose up to 10 tickers. I think I just choose 9. It's a Kirk's new research bot. We'll connect it to our live trading account if we want to. And then what it's doing here on the right-hand side is it's literally just inputting all of the information that we took from the actual trade idea screen. That's it. It's just taking all that information and saying, okay, I'm going to put all of this criteria in so that you can automatically trade. And we can add to this at this point because there's more things that we can do inside the bot. But we can even do something like setting exit options. We can set the bot to remove positions 1 hour before expiration. Wait at least 1 day to avoid being flagged as a pattern day trader. So if you're a new trader, this is really important so you don't enter and close trades the same day. And then if you have any profit taking, like we've done research and showed you guys research on taking profits at 40%, ends up being kind of optimal right now. So we're going to take profits at 40% or otherwise let it go all the way to expiration, close an hour before. We can set those exit options on every single trade that gets automatically entered. And then if we have any additional entry criteria, we would just put it in here. And I might add some other stuff in here, like I don't want to trade around the next Fed meeting if you don't, right? Obviously, we can avoid earnings, we can avoid FOMC, we can avoid dividends. Notice our alpha is automatically put in here. Our EV per contract is automatically put in. Our probability of profit is automatically put in. And then if I wanted to, and I usually add something like this, like the max loss per contract has got to be less than $500. And what that does is that ensures that the position sizing stays small for trades as we get into trades. I don't want to randomly get into a trade that's a $4,000 wide position. And so that's how you basically can ensure that that happens is you take a max loss per contract. And since I know I'm trading, went too far up. I know I'm trading one contract at a time to enter positions, then I know that I'm not going to get into any trades that would meet all the other criteria, all things considered, but also might be a really wide spread. I don't want that. I want spreads that are probably max $5 wide. And then the last thing I'm going to do is I'm going to rank ideas by alpha. We went through this in one of the last episodes where I think it was 2 episodes ago, where we looked at using alpha as our metric to compare essentially the same types of trades to one another. We looked at SPY versus QQQ. And when you use alpha, you're comparing kind of unit of risk per expected value that you're getting. So all things considered, if we find a trade or a list of trades like we do here inside the background of the screenshot that are essentially meet all of our criteria, we have to tell the bot how to find the top one. Now, you don't have to use alpha. You could use the highest expected value or the highest probability of profit or the highest risk reward, whatever it is. But in our case, we wanted to use the highest alpha. That might be the case for you too, but you do whatever you want. And then we simply create the bot. Now, the bot has been created based off of all that criteria. So I described it the other day in a call or webinar or something of saying, like, it's just like ordering a pizza to some degree. We're just like choosing all your toppings, when you want it delivered, how you want it set up. You kind of order it, and then it's all put together. And so inside of this new bot, I have a scanner automation that's already set up. It's got a find trade ideas action that's going to go through all this criteria for me and manage the position using my exit options. You basically have an entire strategy wrapped up in one simple little scanner automation. So you can take what we did today and you can actually start to apply it to trading by just using trade ideas and just going through the process we just went through. Of course, make any adjustments that you want to do to your particular bots or positions. And some of the bots that I've run, like this EEM EV bot, which is based on basically the same type of stuff, I also add some additional types of automations, like I manage for assignment risk. I do some additional tagging and state tagging for just further analysis later on. So it's not that you only have to have one automation running. You can have multiple automations running to do different things. In this case, I have my simple scanner automation, which is spacing out trades for new entries, but I'm also running risk management for short contract assignments. So I'm evaluating whether a short contract is in the money and likely to be assigned. And then if it is, I can help manage the position automatically inside of my bot. So it's a really cool way to kind of use a combination of these things together. Okay, so that pretty much wraps it up for us today. So I really hope you guys enjoyed this show. If you have any questions, as always, please let me know. You can shoot us an email, team@OptionAlpha, jump into the community and talk with us, engage with us there. As always, this research is completely free. We make it free and available on the website. We've got another new research article coming out, I think, next week from our team and Rob. It's super killer. I hope you guys are going to enjoy it. And as always, until next time, happy trading. Take care.